I'm Alex Mozet, and welcome to Winner Take All, where we talk about the constant battle to fight back and win against big tech monopolies. Don't forget to text us at 203-646-5159. You got to text us because who knows, these tech monopolies may just ban us at any moment in time. First topic, we're going to do a deeper dive on VC in 2021, looking at the US, Europe, and Latin America, all very hot markets. So if we look at the US VC climate, I mean, we've talked about this multiple times on the show. Just when you print $10 trillion, things accelerate pretty quickly. Valuations go up, deal sizes go up, everything goes up. And we've seen that in spades. I mean, look at these numbers. 2021, you had about $330 billion in VC investment in aggregate compared to $166 billion in 2020. So almost double the total dollars going into the VC, into tech startup investing. You had maybe a 40% increase in actual number of deals from 12,000 in 2020 to about 17,000 in 2021. You had almost double the amount of dollars and only roughly, call it, a 40% increase in number of deals done. Both huge growth, but you can see much larger growth in just dollars having to go into deals, right? So you see that also in this mega deal chart. So there was, about 330 mega deals, which is a deal with over $100 million going into the deal. 330 of those in 2020 for about $76 billion worth of total dollars. And that drastically accelerated, right? You see, this is where really a lot more money was able to be put to work. Went from 76 billion in 2020 to 190 billion in 2021. From 330 deals in 2020 to 819. Massive increases in both number of mega deals and amount of dollars going into those mega deals. But you also saw inflation, what we call asset inflation. Although there's real inflation, then there's asset inflation. We saw asset inflation climb for valuations. You can see here, the median almost doubled in late stage. It went up by roughly 50% in the early stage. Went up by maybe a third in seed stage, and went up by kind of 25% in angel. And this one I've always tracked this seed and first financing stat. First financings, right? I mean, that's literally what it means. Hey, I just started a tech startup and now I'm raising money for what? The first time. This is a really important stat to track just if you want to look at kind of the overall health of the startup ecosystem. Hey, net, are there more startups getting their first round of funding every year or less? For actually a number of years, this stat was actually declining or plateauing. Now you can see the past couple of years, it's really taken a big uptick, going from about 3,500 in 2020 to about 3,750 in 2021. Also, same thing, much more overall dollars going into those deals at both the seed and angel level. So very positive signs to get that engine going with kind of early stage tech startups, which had kind of plateaued for many years, like mid 20 teens. And now going into this new decade, these past couple of years is really on an upward trajectory, which is really good for the startup community. Overall, angel and seed VC deal activity. So put angel and seed together, which are very similar. You had about 5,300 of those deals in 2020 compared to 6,600 of them in 2021. And also a similarly, outsized increase in total number of dollars going into these very early stage investments. So that's really good news. I mean, it's to be expected when you just print trillions and trillions of dollars. Investors need to put that stuff somewhere. Tech has kind of been somewhat foolproof relative to other asset classes, certainly over the past couple decades. So you're really seeing, if not a doubling, really a tripling down. You can just see investors saying, hey, look, obviously just saying the overall risk profile of these later stage tech companies is not what it used to be. And you can just see as an investment class, as an asset class, as a risk profile, investors being a lot more comfortable putting dollars into these kinds of companies as opposed to other ways to invest. Let's jump to Latin America. Remember that $330 billion number in total VC spend, total VC investment in 2021 in the United States. Now, Latin America has similar kind of up and to the right trajectory, but just on a much smaller scale. Total deal count in Latin America in 2020 was in like the 550-ish range. That spiked up in 2021 to mid 700s. Nice increase there, call it 25, 30%. Overall dollars, though, really blowing up. So 2019, 2020, honestly, basically the same amount of money, roughly $4 billion going into aggregate VC investing in Latin America. That now has spiked to about $14 billion. But again, that's $14 billion for Latin America as compared to $330 billion for the United States. So pales in comparison, but still a massive leap for Latin America. SoftBank being a huge contributor, SoftBank really plowing some money into a number of what are now unicorns in Latin America. SoftBank, one of the top VCs in Latin America by deal count. FJ Labs also making the list. Love FJ Labs. Do a lot of B2B marketplace investing, a lot of marketplace investing in general. Fabrice is their founder, founded OLX, which is like the global version of like Craigslist. Really good marketplace folks. Love what they do in general, making big bets on Latin America. I like Latin America. We are about to announce a deal that we put money into at the end of last year in Latin America. So hit that subscribe button. Don't miss out on that news. It's going to be a really, really awesome announcement for us. Now let's compare that to Europe. In Europe, you had about $116 billion invested in 2021, which was up about 150% compared to 2020. So again, a huge increase. You know, if we look at the unicorn stats as another point of comparison, the US had 331 new unicorns in 2021 as compared to Europe, which had 84. I mean, these are massive numbers. So I'm not just because the US had 331, EU had 84. I'm not trying to take away any applause for the EU. You can see on this map in the EU where they had the most growth in VC investment by country. The UK clocking in at 116%. Sweden's on here. I think that's interesting. There's actually a number of like Klarna on the buy now, pay later Swedish company. There's actually a number of really big unicorns developing there. Lithuania, 990%. I mean, Vinted's out of Lithuania. We have talked a lot about Vinted and Depop, one of the top two kind of clothing, secondhand clothing marketplaces. A huge success story out of Lithuania. Germany, 150%. Spain, 120%. France, 50%. Portugal, 50%. Italy, 165%. Austria, 370%. So you see, really the laggards being France, Poland, Norway, Finland, kind of growing sub 100% year over year. I've talked about the EU kind of having a lost generation where they weren't investing in technology. They weren't doing any tech protectionism like China did to keep the US tech monopolies out of Europe, where there wasn't as much investment in the tech community in Europe. There was then a lot of aggression from US tech monopolies coming in to fill that vacuum. And as a result of that, the overall kind of EU tech economy and startup economy has not been as strong as the United States. And, then you compare that to China, and we've obviously China, a world-class tech community as well, using tech protectionism as a key mechanism for that. So you're certainly seeing a lot of positive notes here with the EU, with, $116 billion invested in 2021 in over 80 new unicorns in 2021, all out of the EU. It's still, a pretty wide margin away from where the United States is. Is it catching up? I mean, it's making a lot of progress. It's not a lost generation anymore, but you can see there's still a lot of ground for them to cover to get to where the US VC community is, tech community is, also where China's tech community is. Will it get there? Will there be parity between the US and EU from just, let's say dollars, number of unicorns, these kinds of things? It needs A, more time, and B, it needs the right policy from regulators to put their tech startups at a greater advantage than other foreign, whether it's US or China. A lot of Chinese tech monopolies are trying to come into Europe also. We have seen some positive things with the EU policy regulators trying to go after tech monopolies. But we've also seen a lot of blunders like GDPR, where GDPR actually hurts smaller tech companies trying to operate in Europe, and it benefits the large tech monopolies. We've covered this many times on the show, like a Google and a Facebook, because they've got all the resources to comply with GDPR. And meanwhile, smaller tech companies, it's a resource drain on them, and they don't have infinite resources like a tech monopoly does. So, I think it's been a mixed bag in terms of how policy and regulators in the EU have been able to structure their agenda to really, drive value to the tech community. Tech communities kind of just had to figure this out on their own, frankly. Not too much benefit from the regulators. I'd say if that changes, if the regulators get their act together, which is a big if, then yeah, you're going to see them get there faster. If we're being a realist, I wouldn't put any faith in the regulators doing the right thing, because why would you? They haven't done the right thing for the past 20 years. They're slowly starting to pick up on what to do with tech monopolies, but that's been a slow, long road. The US regulators are even worse, though, frankly. So I think it's going to take at least another 5 to 10 years before you really start to see potentially kind of what true parity between the two tech ecosystems in the EU vis-a-vis the US. In that 5 to 10 year period of time, I expect we're going to see a massive tectonic shift in development platform, right? So kind of every 10 to 20 years, you see like the internet come out, smartphones come out, right? What's the next kind of tectonic shift in how and what you're building software for? Is it the metaverse, AR, VR, cars and autonomous cars? Is it, right? All these different kind of development platforms. I don't know, but I think that's going to be a huge factor to say, what community is going to really find the next thing and then really embrace the next thing and create all these new tech startups on top of the next dominant development platform? Don't know. Lots of things that could come up on the horizon over the next 5 to 10 years. But the EU is still a number of years away from really getting back to parity. They've made a lot of progress, but certainly not back to parity yet. 2022 is going to be a big year for corporate venture capital, as large tech monopolies have never been more aggressive and have never been more untrustworthy, threatening large legacy industries, forcing traditional enterprises to look where? To look to the tech startup community to collaborate and partner with to combat the common enemy that is big tech. We're going to see a big year 2022 for what we call CVC, corporate venture capital, which is essentially a large corporation doing VC investments into tech startups. So we've seen very nice growth over the past few years in this area. PitchBook's talking about more than 1,500 corporate investors will make a deal in the US during 2022. The need to incorporate emerging technologies and increase the breadth of product offerings has made startup investment a necessary strategy alongside internal R&D programs. New CVC investors are coming not only from high-tech industries, let's say like semiconductors, but from legacy industries threatened by disruption. This is key. So large traditional enterprises needing to say, hey, why don't I explore partnerships, investments, M&A with tech startups? As startups become able to quickly challenge large corporations, PitchBook rationale is a little bit wrong. That's partially true. Really, what I think is driving this is the large tech monopolies aggressively going after more traditional legacy industries, and those incumbent enterprises looking to the startup community as a mechanism to accelerate the enterprise's digitization, digital transformation, embracing new digital models, new digital ways of running their business. That really is the threat. It's not so much the tech startup threatening a multi-billion-dollar enterprise. It's these tech monopolies going into each and every industry they can because they have to show growth. Otherwise, their multiple won't withstand Wall Street's appetite. And so they have to push into these new industries at all costs. And legacy enterprises saying, we don't need to build this all from scratch. And there's a whole vibrant tech startup community here. How could we work with that startup community and collaborate with them? Because the enemy of my enemy is my friend. And who's the common enemy? Tech monopolies. And so we're seeing this in spades. That's why I love this prediction. More than 1,500 corporate investors will make a deal in the US in the year of 2022. Music to my ears, and exactly the right thing that we need to see more of. Count of unique CVC investors that invested in US tech companies. You can see this jumping 20% or so from 2020 to 2021, a little under 1,500 unique investments by CVCs in 2021. So looking at this, not too much of a, right? Like it's going from 1,450 to over 1,500, but overall, it's the right trend. It should be way more than 1,500, frankly. And this is just tracking an actual VC investment. You could also be just doing strategic partnerships, which wouldn't clock into that 1,500, 1,600 number. You could also be doing tech M&A, which also doesn't necessarily clock into that. That's corporate development, not corporate VC, which is really taking minority stakes in an investment in a tech startup as opposed to partnering or buying, which is really the full spectrum. So I think across the full spectrum in 22, we're going to see much more activity with large corporates, incumbent enterprises, turning to the tech startup community, partnering together to fight back and win against big tech monopolies. So we've talked a lot about on the show about Netflix not being a platform company, being a linear company when they should have embraced platform business models. We've predicted for years that Netflix did not have supply side barriers to entry, that they could be competed against successfully much more easily than Wall Street was factoring into their valuation and their multiple. We are now seeing that again in spades. Netflix now raising prices, which makes no sense, especially when you have a lot more competition from Disney, from HBO Max, from Paramount Network, from, Peacock, from Apple TV Plus, Amazon Prime Video, like the list just goes on and on and on. And so what do these geniuses decide to do? Raise prices? Oh boy. Now we see a week or so later after that, Netflix shares sink as companies see subscriber growth slowing. So we see subscriber growth slowing. What should we do? Raise prices. Kind of like that McKinsey article or that story that just came out about Peloton hiring McKinsey and the solution being for them to stop making bicycles. What should we do? Let's stop making our products and fire a bunch of people. Yeah. What should we do? Competition is coming in, creating other high quality content, creating a viable alternative at a cheaper price than us. What should we do? Raise our prices. You know what they need? New leadership. It's time. Yep, here's the stock price. Woo, yeah. Getting crushed, down over 30%, down almost $200 from early January. They were in the high 500s. Now they're in the high 300s. We've been calling this on the show for years. It's not FANG, it's FAMGA, right? Replace the N, Netflix with Microsoft. Now our next story, go check it out, is it's actually not FAMGA, it's now SUS. It's the kind of mid-cap platform stocks who can use M&A as a growth accelerant. Like we saw the old FAMGA from, the past 5-10 years use M&A. FAMGA can't use M&A. Now we're seeing SUS use M&A quite brilliantly. But yeah, don't want to touch Netflix. This is not a buy opportunity for Netflix, okay? This is just more of what's to come. They've had an inflated multiple for years. There's more to go on bringing that down to earth in terms of comps with where the Disneys of the world sit. That's it for us today on Winner Take All. Thank you very much for joining us. I'll talk to you soon.